Hi there. In this revision webinar, we're going to take a look at financial ratios, a key part of getting ready to do well in A-level business. Don't forget, a ratio is all about relationships, in particular the relationship between two values. And of course, in business, there are different values we can explore. For example, the relationship between the revenues a business achieves, the sales, and the profit, how profitable those sales are. So that's one very important ratio or basis of a ratio. Similarly, we can consider the relationship between the assets a business owes and what it owes to other people, other businesses, liabilities. And we can also consider the relationship between the profits earned by a business and how much capital is employed by the business. So financial ratio analysis is all about understanding those relationships, and it does so by exploring financial data. So we draw financial data from the business's accounts to give us hopefully some insights, some useful insights into how the business is performing. And in A-level business, there's really two parts to this challenge. One is, if you're given financial data and asked to calculate a ratio, being able to calculate it accurately. And secondly, and perhaps more importantly, being able to interpret ratio data. You may be given some data to interpret, or you may have the data given where you can calculate a ratio to use in your analysis and your points. And the ability to be able to understand the different types of ratio and use them effectively often differentiates the stronger candidates from the weaker candidates. So where does this information come from that we can explore? Well, basically two parts. The company's accounts are basically formed of the income statement, where we'll find out details of the revenues and the cost of sales and the profits, the various profits that a business earns. And also from what's commonly known still as the balance sheet, formerly known as the statement of financial position. But that's where you'll find out details of the assets and liabilities of the business, current assets, current liabilities, non-current liabilities, and also the amount invested in terms of share capital and reserves. And normally you'll be given an extract from the company's accounts rather than the full income statement or the full balance sheet. In terms of your studies, focus your revision on the three main types of ratio. Not every exam board has all of these ratios in it. The three main profitability ratios explore the relationship between sales or revenues and the profit earned. So the gross profit margin, the operating profit margin, and also perhaps the granddaddy of profitability ratios, the return on capital employed. We'll take a look at all of these later. When it comes to liquidity, here we're talking about ratios that help us assess the financial position of the business, the ability of the business to be able to pay its way, pay bills as they become due. The most important is the current ratio, and for EdXL students, you also need to know the asset test ratio. AQA students don't need to know the asset test ratio. And lastly, on financial efficiency, there is a variety of ratios. I've put gearing in here because I think it's most importantly a measure of how efficiently a business's finance is organised. But also you've got things called payables days and receivables days and inventory turnover within the efficiency ratio group. And we're going to take a look at each of these during the course of this brief revision webinar. As we do, what we'll do is we'll set you some ratio calculation tasks. So please grab hold of a calculator, maybe a smartphone, a calculator, or if you wish, of course, you can do it in your head. And what we'll do is when we set each question, we'll pause the video and ask you to have a go at calculating the ratio, and then we'll go through the calculations to see how you get on. Okay, well, let's start with profitability ratios. And there we have on the screen an extract from the income statement of a business day, with data for 2017 and 2018. So your first task is to calculate a profitability ratio. What was the gross profit margin in 2018? So pause the video now, have a go at calculating it, and then when you're ready, press play and you'll see how you got on. So gross profit margin. Well, clearly to be able to calculate the gross profit margin, and don't forget you need to remember the ratios and the formulae, you're not given them in any A-level exam. Gross profit needs to be calculated for this one. Gross profit is the difference between sales revenue and cost of sales. And then what we do is we divide gross profit by the revenues of the business. So taking the data for 2018, there's our formula. The gross profit margin is gross profit divided by sales revenue. Don't forget, it's a profitability ratio, so we always express that as a percentage times by 100. Taking the data, sales in 2018 of 420,000 less the cost of sales of 240,000 gives a gross profit of 180,000 divided by 420 times by 100, the answer hopefully you got 42.9%. Okay, that's the gross profit margin. Here's another table, this time with some data for two businesses, businesses X and Y. We're given the sales revenue and the gross profit margin, the operating profit margin. Your task is firstly to calculate which business had the highest operating profit in 2018 based on that data. So pause the video and work out the operating profit. Sometimes with ratio analysis information or questions, you're actually given the answer and you can work backwards to work out what the underlying data was. This is an example here because the table tells us that business X had an operating profit margin of 25%, and business Y an operating profit margin of 15%, a much lower operating profit margin. But what was the operating profit of those two businesses? Well, hopefully you calculated that in fact the business has the same operating profit. I've shown the workings there on the screen. You apply the operating profit margin, in the case of business X there, 25%. You times the 25% by the revenues of 1.2 million, and that gives you the operating profit of 300,000. Do the same thing for business Y. Multiply the operating profit margin of 15% by the revenues of 2 million, and they too therefore achieved an operating profit of 300,000. So they have an example of two businesses with the same level of profit, 300,000, but business X has a much higher operating profit margin, 25%, much higher than 15%. And it also has much lower capital employed. So actually, business X would have a much higher return on capital employed. So the operating profit margin is a good measure of the efficiency of the business. Business X's sales are lower than Y, but it's able to achieve the same profit because it's more profitable in terms of its profitability margin. Okay, here's a multiple choice question for you to have a go at that also draws on your understanding of gross profit and operating profit margin. A UK-based manufacturer imports all its raw materials from suppliers in Europe, paying for these supplies in euros. The business then sells all its output to customers here in the UK. Recently, the euro has strengthened significantly compared with the pound. The effect on this, on the gross profit margin and the operating profit margin of the manufacturer is likely to be what? So pause the video, see if you can work out which of those combinations is correct. Let's take a look. Well, the key here is the change that's happening in the exchange rate. We know that this manufacturer is buying its supplies from Europe, paying in euros. The euro has strengthened, which means that the pound has got weaker. So when the pound gets weaker, imports become more expensive. Exports, if they were exporting, would be more competitive. But imports become more expensive, and therefore, if your import cost, your cost of sales is higher, your gross profit margin will be lower. And similarly, don't forget with gross profit, if the gross profit falls, the operating profit will also fall unless you can make savings in overheads. So your operating profit margin will also fall. Answer B. Okay, and the last one on profitability, a quick, another multiple choice question here. Which of the following combinations of changes in a business is most likely to result in a capital intensive business achieving an increase in return on capital employed? Have a go at that one. Pause the video. Well, what do you think? Well, the answer is C. C is the most likely combination to achieve an increase in return on capital employed. Don't forget this key formulae. Operating profit divided by capital employed. For AQA students, don't forget capital employed is non-current liabilities plus total equity. But you may be given the capital employed figure, and we express that as a percentage. So to increase return on capital employed, we can either increase the top part by increasing profit, or we can reduce the bottom part by reducing capital employed, or even better, do both. And as you can see, option C does both. It's a 10% increase in the operating profit at the top of the formulae. That's good news for the return on capital employed ratio, but also a decrease in capital employed. That's lower, that's higher, that should result in a higher return on capital employed. Good. Let's move on now to spend a few minutes thinking about liquidity ratios. And as we've mentioned at the start of the video, liquidity is all about cash. Has the business got enough cash to be able to pay its debts, its liabilities, its creditors as they fall due? And this is where we explore the relationship between the business's assets and the business's liabilities, and in particular, what are known as current assets and current liabilities. Let's just take a quick minute to review what these are in case this isn't familiar to you or you've forgotten what current assets and current liabilities are. Essentially, current assets are cash balances, amounts held at the bank. That's highly liquid, isn't it? You can spend it. It's also inventories or stocks. And it's also amounts owed to a business by its customers. These are known as trade receivables. So in general, there are three main types of current assets that you'll come across: cash, inventories, and trade receivables, amounts owed to the business by its customers. And they together form current assets. And we compare those with what the business owes. And essentially, the two most common current liabilities are, firstly, amounts owed to suppliers, so-called trade payables, and also if we owe money to the bank, if we have a negative bank balance, a bank overdraft. And what liquidity ratios do is consider the relationship between the total of cash, inventories, and receivables added together, dividing them by the total current liabilities, in particular trade payables plus the bank overdraft. Now, for the acid test ratio, which AQA students don't need to worry about, they only need to think about the current ratio, you remove inventories from current assets. It's seen as being a better test of liquidity in some situations. Okay, here's a quick example for us to have a go at. So there's some data that's been drawn from the business, from its balance sheet or statement of financial position. Have a go at calculating the current ratio for business Z based on that data. Pause the video and have a go. So the current ratio is current assets divided by current liabilities. So we need to pick out the relevant numbers. Well, tangible non-current assets, no, those are commonly known as fixed assets. They're not current assets. But cash balances, yes. Trade receivables, yes. And inventories, yes. They are all current assets. So we add those together. That's £4 million worth of current assets. And we divide by the current liabilities. Well, there's no sign of a bank overdraft there, just trade payables of 1.8 million. So current liabilities are 1.8 million. Therefore, the current ratio is 2.2. 2.2. It's not a percentage. It's always expressed as a ratio. 2.2 is the relationship between current assets and current liabilities. Okay, have a go at this question now and pause the video. See if you can work out which of those combinations of changes in the business will increase the current ratio. Have a go. What do you think the answer is? Well, hopefully you worked out that it is B. Answer B. Inventories increasing by 100,000, trade receivables decreasing by 20,000, which must mean that current assets have increased by 80,000. So the top part of the ratio will be higher. Current liabilities, we assume, remain the same. Therefore, that would increase the current ratio. Okay, let's quickly look at now these efficiency ratios. We'll finish off with gearing. Don't forget the three main efficiency ratios: receivables days, payables days, and inventory turnover. Receivables days is how long it takes us on average to wait, or how long we have to wait for our customers to pay the bills that they owe us. So receivables, maybe we allow a customer to buy some goods and pay us in 60 days time. Do they take 60 days? Do they take longer or do they take shorter? So receivables day is how long it takes for customers to pay the bills that we are owed. On the other side of the coin, payables days is how long does it take our business to pay our suppliers? How many days do we try to take before we have to pay our bills to suppliers? And inventory turnover is a measure of how often the inventory is used up each year by a business, by turning it into sales. Okay, let's have a go at doing a receivables days calculation. On the table there, three businesses with some information about sales revenue, receivables. Calculate the receivables days ratio for each of the three businesses and tell me which one has the highest receivables days ratio. Have a go. Okay, let's take a look. Well, don't forget the ratio that we're calculating, we have to memorize these, is trade receivables divided by annual sales times by 365 to give us a figure in days. So for business A, 250,000 divided by a million of sales times by 365. And do the same thing for business B and the same thing for business C to get us 3 lots of receivables days. Which one has the highest one? It is business A, 91.2 days. Business B is lower, business C is even lower than that. 91.2 days on average it takes to wait before customers finally get around to paying our bills. Okay, let's have a think about a question here which combines a liquidity ratio and an efficiency ratio. It's a multiple choice question. A retailer has a current ratio of 5 and an inventory turnover of 10. It decides to significantly increase the value of inventories held by buying more from its suppliers on normal credit terms. What's the effect of this on the current ratio and inventory turnover? So have a go at that question. Let's take a look. Well, the answer is C. It will decrease both the current ratio and inventory turnover. Now, why is that? Well, let's take a look at an example here. We're told that the business is going to hold higher inventory. Well, that kind of makes it easy on the inventory turnover bit, doesn't it? It means the inventory turnover should fall because on average we're going to be holding more inventories in the business. What about the current ratio though? Well, imagine if we added 50,000 to inventory from 500 to 550, and we did that by taking 50,000 worth of trade credit, which is what the question asks. That actually has the effect of increasing current liabilities by 50, increasing current assets by 50, but if we do the maths, that actually results in a lower current ratio, a worsening of the liquidity position. And there's another example just to show the same thing. Okay. Finally, let's finish off with one more ratio, gearing. It's the ratio a lot of students struggle with, perhaps because they don't really necessarily understand what it's trying to achieve. I think the key thing is firstly just to memorize how to calculate it if it comes up, but then hopefully by going through a couple of calculations you'll see a little bit more about why gearing is such an important ratio. Because it's all about understanding how much of a business's finance is provided by debt rather than by share capital and reserves. The gearing percentage, don't forget gearing is always expressed as a percentage, is the non-current liabilities of the business, and you'll nearly always be given that, the non-current liabilities, divided by the capital employed. So don't forget capital employed is total equity plus non-current liabilities. Now if you're given a total for capital employed, that's the bit that you use at the bottom. If you're given a total for total equity and non-current liabilities separately, add them together and that becomes your capital employed at the bottom for the gearing calculation as well as return on capital employed. Okay, don't forget it's a percentage, so we multiply by 100 to get to a percentage. So have a go now. I've given you some data there for business A and business B. Have a go at pausing the video firstly. Well, that's easy to do, pausing your video, but have a go at calculating the gearing percentage for those two businesses. Let's take a look. Well, firstly, we need to add non-current liabilities and total equity together to get to that bottom bit of the formula. So £800 million for business A, 800 million for business B. So they both have the same capital employed. Business A, however, when we calculate our ratio, 200,000 of non-current liabilities divided by capital employed, business A has a lower level of gearing, 25%, than business B. Business B has a higher level of gearing, 62.5%, which means, all it really means is business B has a higher proportion of its finance provided by debt rather than by equity, by shares, by capital and reserves. There's no reason that 62.5% is much worse or better than 25%. Don't believe the textbooks that say gearing over 50% is bad news, because most textbook authors have never run a business, and a lot of businesses succeed very well with high levels of gearing if they can afford to pay the debt. So let's finish off by asking you to think about this data here. Which of those businesses do you think is in the best financial position? So pause the video and have a look at the data and decide based on your judgment which is in the best financial position. Have a go. So what did you choose? A, B or C? Having done this exercise with students quite a few times, a lot of them plump for B because it's got a good operating profit margin, relatively low gearing, decent current ratio, but a high return on capital employed. The more cautious students often choose answer C, business C, because it's got no gearing at all and it's got a better current ratio, or higher current ratio, therefore a better liquidity position. Not many students, though, choose business A. Why are they put off by that? Because of the 90% gearing. But look at the rest of the data. It has an operating profit margin of 20%. That's twice as profitable in percentage terms as business B. And it has a very high current ratio and a high return on capital employed. So the fact that gearing is 90% isn't really an issue for that business. The business could afford, fairly easily I'm guessing, to pay the interest on the debt, to pay the debt as it becomes due. And that's the point about gearing, the point about ratio analysis. Don't always be taken in by the textbooks that say high gearing is bad. If a business has high profits and strong liquidity, high gearing is often the best way for the business to be financed. There's no right or wrong answer to this particular exercise, but just to make the point that if a business has high profits and strong liquidity, high gearing is simply not a problem. Well, there we go. We've had a bit of a whistle-stop tour there through the main financial ratios. We've looked at profitability ratios, we've looked at liquidity ratios and efficiency ratios, including gearing at the end. Hopefully that's been useful. All the best with your revision.